Have you ever been looking at a stock chart, you flick one little setting, and suddenly the whole thing just warps into a completely different shape? Well, that's the price scale at work. And today we're going to decode what that feature is and what your stock chart is really telling you.
So, here's the game plan. We'll start with this puzzle of how one stock can look so different on two charts. Then, we're going to meet the two main players here, the linear scale and the log scale. After we see how they stack up against each other, we'll get into how you can choose the right one for what you're trying to figure out.
All right, let's dive right into the mystery. You're looking at the exact same stock over the exact same time period, but what you see can be, well, dramatically different, all because of one little setting.
And this is the big question, right? On one chart, it looks like all the action, all the explosive growth happened recently, while the early years look kind of flat. But on the other chart, suddenly that early growth looks way more significant. So how is that even possible? It all comes down to the scale on that vertical y-axis.
Okay, so let's start with our first tool, the linear scale. You might also hear this called an arithmetic chart. This is usually the default setting on most platforms, and really, the easiest way to think about it is just like a plain old ruler.
And the key phrase to remember here is equal spacing for equal dollar changes. What that means is the vertical distance between, say, $10 and $20 is exactly the same as the distance between $90 and $100.
And that's the simplest way to lock it in your brain. It doesn't matter if the stock price is $10 or $1,000, a $1 move is always going to take up the same amount of space on the chart. It's all about those absolute dollars. It's that simple.
So let's just break that down. The y-axis has these perfectly evenly spaced price points. A $5 jump from $10 up to $15, it takes up the exact same vertical space as a $5 jump from $20 to $25. This makes it really good for one thing, seeing absolute dollar changes, especially if you're looking at shorter time frames.
All right, now let's switch gears and talk about the logarithmic scale, or log scale. This is the one most professional traders and technical analysts actually prefer, especially when they need to see the real story of growth over time.
And here is the huge difference. A log scale, it really doesn't care about dollars, it only cares about percentages. On this scale, two equal percent changes are always plotted as the same vertical distance.
So if our mantra for the linear scale was a dollar is a dollar, then for the log scale, it's this. It is all about the percentage change. It's not about how many dollars the price moved, it's about how significant that move was compared to where the price was at the time.
And this is where it really clicks. Think about it. A 100% move, whether that's a stock going from $10 to $20 or from $20 to $40, on a log chart, that move occupies the exact same amount of vertical space. And that is what makes it so powerful for comparing growth rates over really long periods. Okay, time for the main event. Let's put these two scales head to head. We'll use a super simple, practical example to see exactly how they tell two completely different stories using the exact same data.
So here's our scenario. Let's call it the $5 challenge. We've got two separate price moves. In both cases, a stock goes up by exactly $5. Now, on a linear chart, these two moves would look absolutely identical, but are they really?
So let's look at that first move, but this time through the lens of a log scale. That jump from $10 to $15, it isn't just a $5 gain. That's a massive 50% increase in the price.
Now, what about that second $5 move? Going from $20 to $25 is still a $5 gain, sure, but in percentage terms, it's only a 25% increase. You see, on a log scale, this difference is completely obvious. That 50% jump is visually twice as large as the 25% jump because it represents double the proportional growth.
This little table just boils it all down perfectly. The linear scale, it measures absolute dollars, and it's best for short-term stuff. The log scale, it's all about percentage change, which makes it way better for understanding long-term trends and the true impact of price moves.
So the whole point here is knowing which tool to use for which job, right? You now have two different ways to look at price, and then when you choose is going to shape how you interpret everything the market is doing.
All right, so let's lock in the big takeaways here. Use a linear scale when you care about absolute dollars, maybe for some short-term trading. Use a log scale when you want to see the real story of percentage growth, especially over the long term. Remember, the scale you pick fundamentally changes the chart's narrative, and that's exactly why most experienced analysts live on the log scale. It gives them that crucial proportional context.
And really, it all comes down to this one question. Are you interested in the simple dollar-for-dollar journey, or are you trying to understand the compounding story of growth over time? The scale you choose is the lens through which you're going to find that answer.